Hey everyone, welcome back to my channel. If you have ever wanted to invest but felt overwhelmed with all the choices you have, like stocks, bonds, and funds, today's video is for you. We are diving into ETFs. ETF meaning exchange traded funds. I will cover their history, how big the ETF market has become, the different types of ETFs you can invest in. I will even give you a real life example to show exactly why ETFs are such a powerful wealth building tool. By the end of this video, you will know how ETFs work, why they have become so popular, and how you can use them in your own financial journey. Let's rewind a bit. The very first ETF was launched in United States back in 1993. It was SDPR S&P 500 ETF, ticker symbol SPY. Its goal was to simplify and just track S&P 500 index. No gimmicks, no fancy strategies, just follow the markets. Fast forward to today, and ETF have taken the investment world by storm. Globally, ETF now manage around 10 trillions in assets. That's larger than entire GDP of Japan or Germany. In fact, in North America alone, ETFs are so common that many retirement accounts, pension funds, and even professional hedge funds are using them as a building blocks in their portfolio. What started as a simple fund in 90s have turned into industry with thousands of ETFs covering almost every sector, region, asset class you can imagine. So what is an ETF really? ETF stands for Exchange Traded Fund. It's basically a basket of investments, stocks, bonds, commodities, or even currencies. Unlike a mutual fund, which you can only buy and sell once a day, ETFs trade on stock exchange in a real time, just like Apple, Tesla, Amazon stock. Here's the beauty. Instead of trying to buy dozens and hundreds of individual companies, you can just buy one ETF and you instantly own all of them. It's like buying a whole fruit basket instead of shopping for apples, bananas, and oranges one at a time. Now, why are ETFs so popular? So, first is diversification. One ETF can give you exposure to hundreds or even thousands of companies. That means less risk if one company underperforms. Lower cost. Many ETFs have expense ratio as low as 0.03% compared to traditional mutual funds which might charge over 1%. Over decades, those savings add up to tens of thousands of dollars. Flexibility. You can buy and sell them throughout the day, just like stock. You want to set a limit order, stop loss, or even trade options on them. You can do that all same like as you do in a single stock. Transparency. Most ETFs publish their holdings daily, so you know exactly what you own in them. Tax efficiency. Because of this structure, ETFs are often more tax friendly than mutual funds. That means fewer surprises in tax liability at the end of the year. So, whether you are beginning to start with just $100 or a professional managing millions, ETFs are a go to solution. Here's where things get interesting because there is ETFs for everything. You name it and you have it. So, there are broad market ETFs like SYP or VOO, which track S&P 500. They are great for long-term and steady growth. Bond ETFs, such as iShares Core US Aggregate Bond ETF, perfect for income and stability. Commodity ETFs like SBDR Gold Share, which lets you hold gold without physically holding it or storing it. International ETFs offers you exposure outside North America. For example, Vanguard FTSE Emerging Market ETF. Sectors and thematic ETFs want to bet on clean energy, tech, or even artificial intelligence. There is a ETF for that. For example, Invesco QQQ for tech-heavy ETF. Dividend ETFs, great for income investors. Vanguard High Dividend Yield ETF is one of the examples. Inverse and leveraged ETFs, high risk tool that let traders to bet on the market or amplify their returns. These aren't just for beginners, but they exist. So if you are confused which ETF should I buy, so go to ETF would be a broad market ETF where that ETF tracks the whole country as like S&P 500, Nasdaq or TSX. Let's make this real. Suppose you want to invest in US economy, you can buy SPDR S&P 500 ETF. Just with one purchase, you instantly own a piece of all 500 companies in the S&P 500. That means Apple, Amazon, Johnson & Johnson, Coca-Cola and more. Instead of guessing which company will be better next winter, you are investing in entire US economy. And history shows it grows over time. For example, if you had invested $10,000 in S&P 500 ETF back in 1990s, today that money would be worth over $200,000, all without picking stocks or without taking stress. So how do I buy an ETF? It's simple. You can purchase them through your brokerage account like Fidelity, Vanguard, TD, iShare, or even apps like Robinhood and Wealthsimple in Canada. All you need is a ticker symbol like SPY, VOO, or QQQ, and you can start with a little cost of a single share. Some broker even let you to buy a fractional share so you could invest with as little as $5. So here are quick tips for you. Always check for expense ratio, usually lower the better, but it depends. Look for liquidity. Popular ETFs are easy to trade. Match your ETFs with your investment goals, like long-term retirement money. Stick with broad market ETFs or bond ETFs. And if you want to take a short-term bet, thematic ETFs could be a better choice. But before taking a decision, talk to your advisor first. So there you have it. ETFs explained, from the humble beginning in 1990s to becoming a $10 trillion industry today. ETFs are one of the simplest and the smartest tools for wealth building. If you have got value from this video, smash that like button and subscribe for more personal finance and wealth management concepts. And drop a comment below which ETF are you most interested in. Thanks for watching, and remember, wealth isn't built overnight, but with the right tools like ETFs, you make it happen step by step. Happy investing.